Ever look at, say, crypto trading volumes and think, wow, things are really moving, but what if all that buzz isn't real?
Yeah. What if it's just smoke and mirrors?
Exactly. Today, we're doing a deep dive into something called wash trading. We're going to unpack what it is, how it works, why people do it, and where it's most common. We're digging into info from FinCrime intelligence for this.
It's a crucial topic.
So it makes you wonder, right? Are those big numbers you see always the real deal?
That's the million-dollar question, isn't it? Because wash trading, at its heart, it's really just a trick.
A trick how?
Well, think of it like this. Someone is buying and selling the exact same thing, pretty much at the same time.
Okay.
Imagine passing something quickly between your left hand and your right hand, just to make onlookers think there's a lot of action.
Ah, I see. Like a performance.
Precisely.
Yeah.
The main point isn't to make a profit on that specific back and forth. It's to create this false sense that there's tons of activity, maybe that demand is high, or the price is shooting up.
But in reality,
In reality, nothing substantial has really moved between independent people. It's just noise.
okay, that makes sense. So it's not about the profit from the buy-sell itself, but how that fake activity makes other people react.
Exactly. It's about perception manipulation.
So how do they actually do it? Is it like one person frantically clicking buy, sell, buy, sell?
Here we could try it manually, maybe in simpler situations, but honestly, nowadays, it's often automated.
Bots.
Yeah, trading bots. Programs written specifically to do these simultaneous buy and sell orders over and over, especially in faster markets or places with maybe less oversight.
Like crypto exchanges or those NFT things.
You got it. Decentralized exchanges, DXs, and yeah, NFT marketplaces.
Yeah.
They're hotspots because the speed helps and sometimes the rules aren't as tight. Automation just lets them do it bigger and faster.
Right. Wow. So, okay, why bother? What's the end game? What are the main reasons people engage in this?
There are a few big ones. First, probably market manipulation. Inflating the volume, making an asset look way more popular or liquid than it actually is. This works well in newer markets, like crypto.
The lure people in.
Exactly. Create that FOMO fear of missing out.
Mm.
People see the activity, think, I got to get in on this. Buy at an inflated price.
And then the manipulators sell.
Often, yeah. That's
Yeah.
the pump and dump connection. Another angle, though definitely illegal in many places, is tax evasion.
How does that work?
You sell something at a loss, create a paper loss to get a tax deduction, then you immediately buy it back, so you still hold the asset, but you've booked the loss for tax
It's
purposes.
sneaky and illegal, you said.
Very much so in regulated markets, yes. And then as you mentioned, the classic pump and dump, use wash trading to inflate volume, attract buyers,
Hmm.
then dump your holdings on them at the higher price.
It really does sound like these newer digital spaces, crypto NFTs, are kind of the Wild West for this. Why is that?
A big part of it is decentralization. Unlike, say, the stock market with the SEC watching closely, the crypto world doesn't always have that clear single overseer.
More gaps in the rules.
Sort of. Or just it's harder to enforce across different platforms and countries. Plus, you've got tons of transactions and people using pseudonyms, right?
Yeah.
Wallet addresses, not names. It just makes tracking who's really trading with whom much harder.
And that makes wash trading easier to hide.
It can, yeah. And get this, some estimates suggest that over half, maybe more than 50% of the reported trading volume on crypto exchanges might actually be wash trading.
Wait, seriously, over half? That's staggering.
It's a deeply concerning number. Shows you the scale of the potential distortion.
Okay. And you mentioned NFTs earlier. How does wash trading work with digital art or collectibles?
Oh, it's definitely happening there too. Several ways. One classic is just faking value.
How?
An owner might set up like multiple digital wallets they control. Then they just sell their own NFT back and forth between these wallets, each time at a slightly higher price.
Ah, so the public transaction history looks like it's in demand and the price is climbing.
Exactly. Makes it look hot. Then maybe a real buyer comes along, sees that history, and pays the inflated price. It's also used to game the system on NFT marketplaces.
Game the system how?
Well, these platforms often rank collections or specific NFTs by trading volume. So if you wash trade your NFT a lot,
It climbs the rankings, gets more eyeballs.
you got it. More visibility. And then there's the really worrying part, money laundering.
Using NFTs for that.
Yeah, the repeated self-trades can create a seemingly legitimate paper trail for dirty money. Makes it harder to see where the funds originally came from.
Man, this sounds shady all around. Is it actually illegal everywhere? Are the regulators cracking down?
Okay, so in traditional finance, stocks, bonds, derivatives, absolutely, yes, it's illegal. Big regulators like the SEC and CFTC in the U.S., The FCA in the UK, they have clear rules against it.
And the penalties.
Can be pretty severe. We're talking heavy fines, getting banned from trading, even criminal charges sometimes.
But crypto is different. It's more complicated. The intent to stop manipulation is usually there, but actually doing it is patchier. The regulations for digital assets are still evolving. Different countries have different rules, some much looser than others.
So loopholes exist.
Potentially, yes. But the trend is definitely towards closing those gaps. There's a big push globally for clearer crypto rules and stronger enforcement, specifically targeting things like wash trading.
Okay, so if it's happening, especially in crypto and NFTs, how do exchanges or regulators even spot it? What are the red flags?
They have techniques. It's about spotting activity that just doesn't look like normal trading. Behavioral analytics is a big one.
Looking for weird patterns.
Yeah, like the same wallet buying and selling the exact same NFT back and forth really fast. That's not typical investing. Then there's on-chain analysis, especially for DeFi and NFTs.
Digging into the blockchain record.
Exactly. Following the transactions, looking at the timing, the amounts, trying to link wallets that seem to be working together when they shouldn't be. They use things like clustering algorithms, grouping suspicious wallets.
Right. If a bunch of wallets trade in a weirdly similar, coordinated way, maybe they're all controlled by one person or group. And just general pattern recognition flagging trades that make no economic sense or are just super repetitive.
Sounds like detective work.
It is. And increasingly, they're using AI and machine learning to help sift through all that data and tell the difference between legit high-frequency trading and manipulation.
Using tech to fight the tech abusers makes sense. Are we actually seeing consequences? Are platforms or people getting busted for this in the crypto world?
Oh yeah, definitely. Enforcement is ramping up. Regulators are going after crypto platforms they think are either turning a blind eye or actively helping wash trading happen.
Like fines for exchanges.
Fines for reporting fake volume numbers, absolutely. We're also seeing investigations into NFT creators who
Yeah.
seem to be just trading their own stuff to inflate prices.
And actual charges.
Yep. Civil and even criminal charges against people running schemes that involve wash trading. So the message is getting clearer. What might have seemed like a gray area before, not so much anymore. It's becoming a clear enforcement target.
This has been super insightful, but let's bring it back. Why should someone listening, maybe someone not heavily into crypto or NFTs, actually care about wash trading? What's the bigger picture?
It matters to everyone, really, because it corrodes trust. Trust in all markets. If you can't trust the reported volume, if you can't trust the price discovery, well, that's fundamental.
It distorts the whole picture of supply and demand.
Exactly. It can lead anyone, even in traditional markets eventually, to make bad investment decisions based on fake signals. And like we touched on, it's a tool for illicit finance.
Hiding dirty money.
Yes, creating that fake transaction history helps launder money. So fighting wash trading isn't just about crypto. It's about protecting the integrity of the whole financial system. That's why financial crime teams, regulators, platforms, they're all working on better surveillance.
Okay, so to wrap it up, wash trading is basically faking market activity. It's illegal in traditional finance, but a real headache in crypto and NFTs because the rules are still catching up. And it's bad because it warps prices, misleads investors, and can even help criminals.
That's a perfect summary. It just paints a false picture, and that undermines the transparency markets need to function properly.
Well, this was a fascinating deep dive. Definitely makes you look at those flashing numbers on exchanges a bit differently. So here's something to chew on. As tech keeps racing ahead, especially with digital assets becoming more mainstream, how do we even define real value or real activity anymore? How will our methods for spotting fakes like wash trading have to evolve just to keep up? Makes you think about what trust and transparency will even mean in the markets of the future.